Hello, everybody. Good morning. It's a true pleasure to be here today. We put together an excellent line of speakers, so I hope that you keep engaged, and please feel free to ask questions in the panels, and we try to be more engaged discussion. I am Filiz Ünsal. I'm the head of Structural Policies and Research in the Economics Department of the OECD, and I'm here today to, as also a partner of the CREET Center from the Paris side. And I will be introducing and managing the discussion in session 1, where we are going to discuss aging, longevity, and monetary policy. Obviously, it's a very, as mentioned before, this is one of the most important challenges for the policymakers in the years coming. But we are also seeing a lot of opportunities, and hopefully these opportunities will, today, through our discussions, we are going to make it more visible. So we will start our session with Oscar Arce, who is the Director General of Economics at the European Central Bank and Chairman of the Monetary Policy Committee of the European System of Central Banks since February 2022. He was Director General of Economics, Statistics and Research at Banco de España during the period 2018-2022, where he also served as non-voting member of the Europe Executive Board and the Governing Council, alternate to the Governor on Governing Council of the ECB and member of the EU Economic and Financial Committee. Previously, he held several responsibilities at the Banco de España, the Spanish Securities Markets Commission, and the Economic Bureau of the Spanish Prime Minister. Mr. Arce holds a PhD in economics from London School of Economics and MSc Economics from the University College London. Thank you very much for joining us today, and we are looking forward to your keynote.
Thank you, Filiz. Good morning, everyone, and thanks to the organizers for inviting me to participate in this very exciting conference dealing with one of the most important topics that one can think about in the field of economics. A pleasure always to be in Athens, and a special pleasure to be here at the Bank of Greece. So, as the minister said, aging is probably going to have an impact in every single corner of our economies. This, I think, is out of question. As Andy Scott just said, aging is not only about problems or challenges, it's also about opportunities, transformative realities. Today, however, I will restrict myself to focus on some challenges coming from aging, challenges of macroeconomic nature, and I will limit myself to the geographical jurisdiction in which I can say something, which is the Euro area one. So with this, let me use a few slides. I will divide my remarks into two blocks of questions. First of all, I will highlight some of these macroeconomic challenges created by aging societies, and later on I will reflect on some elements that can help us to buffer or to solve or even to turn around some of these challenging points. But before that, let me provide you with some general overview of the large figures in terms of aging in Europe, in the Euro area in particular. So two important messages coming from the chart on the left, which is just the last two projections run by the European Commission in the aging report, the one in 2019, the previous one, which is the blue line there, and the most recent one published in 2023, the yellow line there. One important message is that we should expect a contraction in total population in Europe in the coming years. All possible scenarios are telling us that, well, the speed may vary depending on the assumptions, but we are going to lose population in the coming years. Importantly, the projections made in 2019 turned out to be a little bit more pessimistic than what happened at the end of the day. The baseline was the solid blue line at that time, and the most recent baseline is the solid yellow line, which is very much close to the dotted blue line there, which was the risk scenario contemplated in 2019 including the possibility, the upside risk of having more immigration than considered in the baseline scenario. And this is what happened. We had more immigration flows, and this has helped to slow down this process of aging. Of course, we don't rule out the possibility of getting more inflows of foreign workers than expected, and actually I will say something on this at the end of my presentation, but the message is still there. I mean, under reasonable assumptions about immigration, Europe is still going to lose some significant part of its population in the coming years. So in the middle chart here, I'm showing the evolution of the key socio-demographic groups, and well, the takeaway there is very simple. In the coming years, we should continue seeing a significant increase on the population of persons older than 65 years, of course at the cost of a declining weight of the younger groups, especially of the middle-aged groups, the purple line there, and the young group, which is the blue line there, that have been decreasing for a number of decades right now. So with this, it's not a surprise that the old age dependency ratio that I'm showing on the right there is expected to increase gradually in the coming decades. The two bars there, the yellow and the blue line, correspond to the two previous projections, demographic projections discussed earlier. In both cases, the dependency ratio is expected to increase. It is true that in the most recent one, the yellow bars there, this increase is going to be a little bit more gradual thanks to immigration. But again, an important message here. Even if immigration turns out to be stronger than anticipated, it will not be enough to mitigate this upside trend in the dependency ratio. At most, it will have a moderating but second-order impact on it. So let me mention some. I have selected just a few areas in which aging is going to have an impact at the macroeconomic level. Certainly one is the labor market. Here I'm showing on the left some basic data on the unemployment rate in the euro area, which right now is at its historical low level of 6.2%. This was the figure in April. And aging here is contributing to keep this unemployment figure relatively low. Why? Essentially because when we look at the counterfactual scenario in which we don't take into account the changes in the unemployment rate of the older workers, and this is essentially done in this dotted yellow line, which is constructed assuming that nothing has changed in terms of the unemployment rate of the older workers, unemployment would be higher. This means that older workers are contributing to push down the unemployment rate in the euro area. And this is the combination of several factors. First of all, the unemployment rate of older workers is significantly lower than that of other demographic groups, and they have increased over the last few years the relative weight on the labor force in the euro area. So these two effects are giving rise to a strong composition effect that is contributing to lower unemployment in the eurozone. So this regarding the level, the impact of aging on the level of unemployment. In terms of the volatility of unemployment, on the right, I offer some also illustrative evidence that essentially tells us that having more older workers in our labor force is probably going to render the unemployment rate less volatile than otherwise. And this is so, again, because the unemployment rate of older workers is not only lower, but also less volatile than the average. So this is also contributing to keep unemployment less volatile than in the past. Well, I'm sure that all of you are aware of the very special circumstances that have surrounded the labor markets in Europe and probably everywhere else as well. In the last few years after the pandemic, labor markets have been typically quite tight. And there are many factors probably explaining this relatively high level of tightness in the labor market. But I mean, this descriptive evidence about what is going on the aging front is probably telling us that aging is an important factor in explaining this relatively high and persistent level of tightness, at least in the labor market of the euro area. So one aspect in which, macroeconomic aspect in which aging is having an impact is in terms of growth, and in particular of the potential growth of the economy. Here on the left, I'm showing the estimates of the European Commission on potential GDP growth for the coming decades. And importantly, over the last few years, this was very visible in the bar to the left, corresponding to the year 22. The main factor contributing to potential growth was indeed the labor input. That was essentially coming from population growth, in many cases coming from foreign workers getting into the euro area, and I will explain this later on. Now, looking ahead, given the projections on population that I showed you before, the European Commission thinks, and we at the Eurosystem would agree, that this factor, demographics, is going to lose steam in the coming years and decades. So the contribution of this factor of population growth and labor force growth in the coming years in Europe is probably going to decline. And this poses a risk in terms of potential GDP growth. We expect technology, we expect an increase in total factors productivity, that is the efficiency in the economy, to compensate for this loss of human resources. We'll see, but certainly demographics will not contribute too positively to GDP growth in the coming decades. Now, one aspect, both the Minister and Andy were touching upon it, on which aging is becoming already very, very visible in our economies, is in the public finances area. And as I can show there in the right chart, between now and the decade of 2070, the European Commission is expecting a very significant increase in total budgetary cost associated to aging, mainly related to long-term care, healthcare, and pensions. And the magnitude is quite significant, with an average increase of 1.5 percentage points of GDP, higher expenditure related to this very much aging-linked items. In terms of pensions, of course, this is going to be, it's already been a big public debate question in many of our countries. The increase in the dependency ratio, this is the message from the exhibit on the right, is adding a lot of pressure on public pension systems everywhere. The only way, the only levers available to any government around to keep the impact of this increasing dependency ratio under control is to reduce the benefit ratios in many cases. And this is what many governments are trying to do, or at least trying to commit to. But certainly the pressure coming from the demographic trend on the pension systems everywhere is going to be quite significant. Of course, reducing the benefit ratio, as many governments are trying to do these days, is not panacea, and it comes with huge political difficulties, as we know. Now, one aspect that is close to our heart of those of us in the monetary policy business, central bankers, has to do with the impact that aging may have on the macrofinancial environment in which we operate our monetary policy. And the way we look at this question quite often in central banks these days is to look at the impact of aging on the natural rate of interest, the so-called Arce, which is the interest rate that would prevail in an economy which is in an equilibrium, in a sort of a steady state, where inflation is also stable and equals the target of the central bank. So what we have seen over the last decades is a very strong correlation between, on the one hand, a quick aging of most Western but also emerging market populations, as you can see on the left chart over there, that has coincided with a significant decline in essentially all available estimates of the natural rate of interest. Some smart people have also conducted some causality analysis on this, linking aging to the fall in the natural interest rates. And there are many channels through which this connection can be made on pure economic grounds. As an economy, as a society gets older, it typically invests less, so the demand for funds typically goes down. And at the same time, it tends to save more, so the supply of funds goes up, and this implies that less demand for funds, higher supply of savings typically implies a lower interest rates. So it's sensible to assume that an economy that is getting older is probably an economy that is going to operate with a notional natural rate of interest that is lower than otherwise. And this has implications for the monetary policy, because our job as monetary policy makers can be described in a very simple way as of trying to emulate through our nominal interest rate decisions what happens with the natural interest rate. If the interest rate gets too low, and it may be, well, negative already, and probably is going to get more negative in the coming years, this implies that in order to achieve our price stability targets, we will have to implement very low nominal interest rates. And this implies that at some point we may be constrained by the zero lower bound or the effective lower bound on our nominal interest rates. And at the end of the day, this means one can make the association between an aging society and some potential loss of effectiveness of our monetary policy, with the result of facing more than often and more than desirable disinflationary forces. Andrea Ferrero, who is luckily participating in this conference, has written extensively about this connection between demographics and inflation. Well, this is a picture from a paper which I found very, very interesting, written by Andrea Papetti from Banca d'Italia, where he simulates what may happen with the natural interest rate in the euro area for the rest of the century. His baseline is the dotted blue line at the bottom, which would be consistent with a very low, quite negative natural rate of interest, around minus 1.5. And then he simulates some changes in two sets of variables. One, technology. He assumes that TFP could be significantly higher than what we expect it to be. And this counterfactual assumption, based on a much better than expected productivity growth, would move the natural interest rate from the blue line to the black line. Still, there is a big gap between where the natural interest rate would be, which is around minus 1%, and the zero line, which would be consistent with more or less today's situation. And this gap is explained by demographic variables. So this means, my reading of this interesting piece of research is that even if, as an economist, we are able, or economic authorities are able, to increase significantly the degree of efficiency of our economies, that is increasing significantly, maybe even in an unrealistic way, our productivity, it will still be the case that demographic factors will push down significantly the natural rate of interest. And this comes, as I said before, with some special challenges for monetary policymakers. Let me now turn to some potential factors, areas of economic policy work that, if correctly activated, could help mitigate some of these more adverse consequences of aging on our economy. In the labor market, well, most indicators in the last few years have been quite positive in the euro area. Actually, I can tell you the labor market is the strongest element of the macroeconomy of the euro area, and it has been doing so for a number of years now. And in part, it's thanks to the good developments there of older workers. We didn't have in the euro area anything like the Great Resignation in the US during the pandemic. More on the contrary, what we saw right after the pandemic, after the beginning of the pandemic, is that the participation rate of older workers just increased in the euro area, and increased significantly so. So the supply of labor coming from older workers in the euro area has been, these days, quite elastic, and this has been very helpful in order to mitigate these tightening forces in the labor market. Now, having said this, there are some important challenges in our labor market that are somewhat related to demographics and should be probably tackled if we want to improve the prospects for potential growth. One has to do with the secular decline in hours worked. In the last few decades, we have seen a significant, gradual, but significant and persistent fall in the average number of hours that we work. And this is probably related to many things, including demographics, including the increase in the participation rate of some groups that contribute with a relatively lower number of hours, like in some cases older workers, in some cases females as well. But it has to do also with preferences, and in some cases, and this is probably important from an economic policy perspective, it may relate to some obstacles that impede some workers to provide more hours, to work more hours. And probably this is something that should become a policy priority, in my view. The other important aspect in which we must improve our figures is in terms of productivity. Productivity per worker or per hour is the same story, has been quite disappointing in the euro area in the last years. Certainly this has been the case after the pandemic. Now it's recovering a little bit, but probably is not sufficient in order to deliver an appropriate rate of growth and also to help mitigate inflationary measures, because lower productivity means higher labor cost as well. So let me turn to this low productivity problem. What can we do there? Well, in principle, we should invest more and better than what we have done so far. In the short term, I think that the priority is to culminate, to finish the Next Generation EU program that was intended, as you know, to facilitate not only investments in the most vibrant sectors like digitalization and the green transition, but also to provide incentives to the European countries to implement significant structural reforms. Well, it is time to go for the last mile of this project to culminate all these investments. We have some internal calculations that we are showing here on the potential impact on productivity. It's not going to be a game changer, among other things, because it's not a permanent program, but it can help. It can help to improve productivity. We estimate that it could do so by increasing TFP by an average of 0.1, 0.2 percentage points per year at the end of the horizon, which is not a big thing, but is something relevant. Perhaps more relevant than this, and this could be potentially a game changer, we'll see, is artificial intelligence. On the right, I'm showing some estimates conducted by some colleagues in Frankfurt about the potential impact of AI on the euro area productivity growth. And well, they estimate, with a lot of uncertainty, of course, that AI could eventually increase our productivity by around 3 or 3.5 percentage points over the next decade, this is something very significant. So for the euro area, it's paramount not to miss this important trend of artificial intelligence if we want to compensate for some of these forces that are going to dampen growth, including those coming from aging. Let me mention something on immigration. As I said before, the euro area has benefited much from the incoming foreign workers in the last few years. Actually, as you can see in this picture covers essentially the post-pandemic period. The red bars correspond to the contribution of foreign workers, that is, workers coming from outside the euro area, to the growth of the labor force. And as you can see there, I mean, roughly speaking, over the last few years, half of the increase in the labor force in our countries comes from foreign workers. In the year 24, which is in this small exhibit on the right, last year probably it was 60–70% of the increase in labor force was due to immigrants coming from outside the euro area. So this is a big thing, which of course has consequences for growth. Recently, some of us, with some colleagues in the ECB, we wrote a very simple blog based off the composition of growth between productivity and workers, nationals and immigrants. And what we found here, what we found there, which is summarized in this picture, is that most of the growth in the last few years comes from foreign workers, both in terms of the larger number of foreign workers, but also in terms of their higher participation rates in the labor force. For instance, in 24, again, I'm focusing here on the right exhibit, around 80% of growth last year, 24, was due to more foreign workers participating in our labor market. So foreign workers have been probably the main driver of growth of the euro area in the last few years. And there are some relatively positive news, with some, I say this with some caution, of course, because data on immigration, as many of you know, is not always as updated as we would wish. But there are some relatively positive signs in terms of the composition of the flows of migrants that we are receiving these days. On the left, I'm showing some data that essentially tells us that compared to the flows of immigrations that we got some years ago, now it seems that the average level of skills of migrants is higher than what we had in the past. Actually, there has been a significant increase in the proportion of foreign workers that get into the euro area with a relatively high level of skills. At the same time, the flow of foreign workers with low skills has dropped significantly in the last few years. So we are getting immigrants that on average come with better skills. However, and this is the message from the mid panel here, there is still a very significant overqualification problem with immigrants. So the allocation of immigrants to the corresponding jobs is still quite suboptimal. They are still much more frequently than nationals overqualified for the job that they are doing. And a final positive point here is that what we see in terms of academic attainment is that, okay, the first generation of immigrants typically do worse than the corresponding nationals in terms of the final degree of academic attainment, but the second generations of immigrants are doing more or less equally well as nationals. So there is a real degree of assimilation there that seems to be working, at least with respect to this dimension. And let me just mention, finish with a mention to a recent paper, actually it's work in progress by some colleagues at the ECB, Consolo and Simadamo, where essentially they are building up some relatively large-scale macroeconomic models where they take a serious view on demographic factors. And essentially they show that in those economies that have undergone significant demographic transformations, like Japan, but also Spain and Italy, if you don't take into account the evolution of demographics, if you don't take into account some basic elements like the endogenous decision of participation in the labor market over the life cycle, the corresponding estimated macro model will do a very poor job in estimating the evolution of GDP. Look at Japan, which is on the right top corner. In the model without taking into account demographics, which is represented by the yellow line there, the model would tell us that Japan has done and is expected, has done actually quite badly in the last few years, with a growth of GDP well below what the model would prescribe. Now, when you take into account demographic changes, when you endogenize some critical decisions like the decision of participating in the labor market, then the prescription of the model would be represented by the red line there, and the picture is completely different. The model would tell us that Japan has done actually pretty well, given, and this is an important condition, given demographic factors. So my takeaway from this work is that it's absolutely crucial for those of you working on macro modeling to take into account demographics, especially when thinking about medium to long-term questions. But given what has happened in the euro area in the last few years, I think it's probably also important to put demographics at the center even of the short-term analysis. So I will stop here. Thank you.
Sorry. We have a few minutes for questions, so if anybody would like to raise anything, we'll be happy to. Yes, please. Sorry, the mic is coming.
Okay, can you give us a hint about how artificial intelligence can help with aging? You mentioned that the aging problem may be better if we use artificial intelligence efficiently, correct?
Yeah.
Can you give us a hint about the quantification, how you measure it, how you measure the impact of the artificial intelligence to the aging problem?
Well, actually, yeah, well, that's an important point. What I mentioned here is actually a very, very basic argument. On the one hand, as I said before, we should expect a lower contribution from labor, from demographics to potential growth, and probably to real growth at the end of the day. So one aspect in which we should probably focus if we want to keep up potential growth, which at the end is a statistic that is probably related somehow with prosperity and social welfare, probably it's time to kind of replace this lost input by investments in artificial intelligence or other form of capital. I was focusing on artificial intelligence here because, well, you know, it's the big revolution, technological revolution in front of us. But I was not trying to make any direct connection on how to use AI in connection with, I don't know, older workers or whatever. I'm not trying to take this jump right now. I'm sure that some people are thinking of how to improve the attachment of senior workers to the labor market by using artificial intelligence. This is a challenge. I have not mentioned it here, but I think we need older workers, senior people probably to stay longer in the job market and to stay in better conditions, better health conditions, better economic conditions as well. Because as Andy said, I mean, it's good that we are going to live more, and this is out of question, is something absolutely positive, but we have to finance it as well. And probably this means that in the margin, we have to work a little bit more. And I think that artificial intelligence is probably going to help us in the last stages of our professional careers, but we'll see.
Thank you so much, Oscar, and we will have you later for the panel discussion again.
Very good.
Thank you.
Thank you so much.
Thanks. Thanks. Now we will have David Miles. He's a professor of financial economics at Imperial College, London. He has had previous academic positions at Birkbeck College, London, and at Oxford University. He has undergrad and master's degrees from Oxford University and a PhD from the University of London. He's a member of the Budget Responsibility Committee of the Office for Budget Responsibility, where he takes the lead on economic analysis. He is a member of the Commission of the Central Bank of Ireland. He was a member of the Monetary Policy Committee at the Bank of England between 2009 and September 2015. As an economist, he has focused on the interactions between financial markets and the wider economy. He was also chief UK economist at the Morgan Stanley from October 2004 and May 2009. In 2004, he led a government review of the UK mortgage market, which was highly regarded. In 2018, he completed a review for the UK Treasury on reference prices of UK government bonds. He has also been an advisor to the IMF and to the Reserve Bank of New Zealand. He's a research fellow at the Center for Economic Policy and Research and at the CESINFO Research Institute in Munich. He was awarded a CBE in January 2016, which is the highest ranking order of the British Empire. We are very happy to have David with us, so please come to the floor. Thank you.
Thank you very much. That was a very nice long introduction. It made me sound far more important than I am. It's very bizarre to be given an award which is given to some British people called a CBE, which I got from the Queen. It's bizarre because CBE stands for Commander of the British Empire. And when there isn't a British Empire anymore, we don't have many ships, so there aren't enough ships to go around all the commanders of the British Empire that there are. So it's a very silly British old tradition. Anyway, that is not what I came to talk to you about. What I'm going to talk to you about is that, saving financial markets, what might happen as we all grow older. So it's a very speculative title, and what I'm going to do is speculate a bit rather than come out with precise forecasts of what might happen in the future, which is always a dangerous thing and almost guarantees you to be wrong. But I want to think about some of the, I think, very large potential financial market consequences, both consequences for aggregate financial markets, but also for individuals, and in particular the changing pattern of risk and where risk sits as population ages. And I think that pattern will change, partly because of the fiscal strains that aging of populations is likely to bring. And much of what I have to say, I think, really is about the fiscal consequences of aging more than perhaps the monetary consequences. That's partly a reflection of what I do at the moment, which is to sort of head up economic research at something called the Office for Budget Responsibility. This is the UK, for those of you who don't know, this is the UK equivalent of what in the US is the Congressional Budget Office. The job of the Office for Budget Responsibility is to assess what the likely fiscal outcomes are for the UK, the balance between government spending and tax revenue, fiscal deficits, the stock of debt, the risks around central forecasts, and whether or not the government of the day is or is not likely to hit its fiscal targets. And when we produce some of our assessment of those things over long horizons, and we produce 50-year ahead projections, as you could imagine, they are highly sensitive to assumptions one makes about the population structure of the country. And it's some of those fiscal aspects that I want to spend some time talking about. And I'll illustrate some of the issues, I'm afraid, largely with figures from the UK. Oscar shames me because he had some wonderful charts of the major parts of the world, the US, China, he had the European Union. Of course, the UK now gets left out of all this. So I'm going to sort of a minor corrective by being very parochial and nationalistic and showing you some numbers for the UK. But I think the issues that affect the UK are common right across Europe. So there's nothing particularly special about the issues that there being more older people relative to younger people generate in the UK. So I'm going to talk a little bit about the demographics and what's likely to happen. I think we're all very familiar with that, so I'll be very quick through that. I'm going to spend a bit of time talking about pensions and what you might call the direct fiscal problem that aging generates for governments, but perhaps spend more time on the impacts for individuals, which in turn generates a whole series of issues about the adequacy of savings for retirement, which generates an indirect fiscal problem for governments who may have to step in to a greater extent than they do already in supporting people in older age. And I want to spend a little time thinking about the shifting pattern of risk between the state and corporations, who in the past, I think, have taken in many countries a lot of the risk connected with providing resources for individuals in old age. The shift that is underway, pushing more of that risk back on individuals, and some of the consequences of that, and whether or not a degree of intergenerational risk sharing through new types of pension system might be a potential answer, something about which I am far more pessimistic than many. Certainly, some people in the UK seem very optimistic about that, and I'll explain what I mean a little bit later. These are the kind of charts you've seen many, many times. I'm not going to spend long on it. This is a picture of the UK population structure as it was 50 years ago, as it is roughly now, and as it is possibly likely to be 50 years in the future. I don't think these kind of pictures are very different for lots of countries, certainly in Europe. If you look at what people typically, and I agree with Andrew Scott, it's an arbitrary line to draw between the old and the younger. But if you were to draw that arbitrary line at 65 and go back 50 years ago in the UK, about 14% of the population of the UK was above the age of 65. 50 years later, pretty much now, that proportion is about 18%. So it's gone up, but not very dramatically. But looking ahead 50 years down the line and making assumptions, of course, about fertility rates, how many children do people want, how many babies on average do women have during their life, making assumptions about that and longevity, and crucially about net immigration, making what I think are plausible central assumptions, that would generate a demographic structure as shown in the right-hand block there. That would be about 28% of the population aged over 65. So a substantial increase on the 18% now, and relative to where we were 50 years ago, the proportion of the population above 65 by 2074 will be about double. So a fairly substantial movement. I want to think about what that means for explicit savings for retirement that are in one way or another in pensions. And this chart is an illustration of the relative significance of state-provided or public pensions and private, generally funded, not always, pensions. So this is really the flow of payments of pensions relative to GDP, which come from either the state paying pensions, that's the green blocks, or from private pensions. Those private pensions could be either company pension schemes, contributions made by workers but also by employers during a working life, generally funded, building up a stock of assets, those are used to pay payments in retirement, or they could be individual pensions, not directly linked to employment, but just regular savings made by individuals into a private pension. So the black block is just the sum of those, measured as how many payments of pensions that are coming out of those kind of schemes relative to GDP. The UK is, somewhat unusual. There it is, sort of 2/3 of the way down, in that the black area, flows of pensions from private schemes, are about as large as payments of public state pensions. And that's a relatively high share of private pension wealth. And you can see there's countries higher up that list, Italy, Greece, France, a much higher proportion of explicit pension savings, if you like, or pension payments, I should say, coming from the state. But even in a country like the UK, with a relatively low proportion of total pensions coming from the state, the pressure on the state of aging, if there isn't any more than what's already planned increases in the age at which people receive the pensions, and if state pensions remain as generous as they are, the fiscal pressure from aging is likely fairly substantial. Here's again a central estimate made by the Office for Budget Responsibility in the UK of what the story looks like in the UK. It's a pretty substantial rise from about 4.5% or so of GDP at the moment paid in the form of state pensions, rising to about 8% over the next 40, 50 years or so. And one could imagine that those countries where a much higher proportion of overall pensions are paid by the state, that increase, the level change, is likely to be bigger again. And there's plenty of risks around that forecast depending what happens to working ages and longevity. One of the problems for fiscal policy, and I think this is true across Europe, is that unless there are some fairly substantial changes in policy in terms of the generosity of state pensions and the age at which people get them, the fiscal burden of aging is likely to be significant. And of course, it's coming on top of a situation where the stock of debt to GDP, government debt to GDP, is far higher than anybody might have imagined 10 or 15 years ago, with debt GDP ratios of 100% and more across much of Europe. And a whole range of other pressures likely to be putting upward pressure on that as well, one of which is defense spending. And so the direct fiscal implications of aging strike me as quite substantial. One answer, of course, is to try to reduce the generosity of state pensions and encourage greater saving in private pensions, either linked to companies or just individuals directly making savings into their own personal pension. The UK has gone down that road quite significantly, perhaps more than many countries. But even so, the likelihood at current levels of saving into private pensions, the likelihood that that will generate sufficient resources to allow the state to step back from providing relatively generous state pensions and prevent fiscal pressures rising, that situation doesn't look terribly promising. Let me show you a few estimates. I want to move on rather quickly of whether or not, based on the levels of saving into private pensions added on to the level of the state pension, whether or not at current rates of saving into the private part of that and maintaining the level of the state pension at its current level of generosity in real terms, that is likely to generate adequate savings for old age. And of course, the difficulty with this calculation is, well, what do you mean by adequate? I will show you just some estimates here based on a particular definition of adequacy, which is a replacement rate. That is, what is the ratio between the pension someone will receive and the level of income toward the end of their working life they may have earned. So these are sort of averages. And this is the proportion of the population in the UK that would be projected to miss a particular level of that target replacement rate if savings were to continue at the current rate and the generosity of the state pension was to stay where it was. And this differs, of course, significantly depending on people's level of income. So we've shown it here for different levels of pre-retirement earnings. And it shows something that looks a little bit strange at first, which is that as you take people who are earning more and more and move to the right in the graph, the proportion of people who will miss somewhat arbitrary targets of 50% or so actually raises. And the reason that's true is that the state pension in the UK is more or less flat rate. So it provides a relatively high replacement rate for someone who has had very low earnings, but a much lower replacement rate for someone on much higher earnings, which is why the numbers are higher as you move to the right. And that the higher private sector pension wealth accumulated by somebody on higher earnings is not enough to prevent really rather significant proportions of people apparently missing this somewhat arbitrary target of around about a 50% replacement rate. The story is rather different if you decided you were going to measure adequacy of pensions in retirement by an absolute level rather than relative to what your earnings had been in the past. And they're not surprisingly, perhaps, people who had earned a relatively low amount in their working life are much less likely to reach what is rather arbitrarily considered an adequate level, an absolute adequate level. They're more likely to miss that than people on higher earnings. Whichever way you look at it, there are substantial numbers of people, either measured measuring adequacy as relative to their earnings or just absolutely, there would appear to be a relatively large number of the population in the UK who are not saving enough to generate at least pension income that they could rely on in old age. And that's, I think, has fiscal consequences, because it means that the option open to the government of simply reducing the generosity of the state pension to offset the rising cost to the government of paying state pensions as more and more people move into older age is difficult, because it may well generate problems of savings adequacy and more older people falling back on other state support and state benefits because they simply can't live on accumulated pensions. There's some offsetting factors, however, which is that obviously it's not just explicit receipt of pension income that people have to rely on in old age. Housing wealth may have accumulated, people can move to smaller houses, there is other forms of saving that people can rely on. So this is sort of indicative of a problem rather than a cast iron proof that this is a real problem that governments will have to face further down the line. I want to briefly mention one issue which reflects a couple of pension tensions that have occurred in the UK and I think other countries as well. What the government in the UK has done in recent years is make it more or less, not quite mandatory, but they've very strongly encouraged people to contribute to private pensions. But these pensions have increasingly become defined contribution pensions, and defined benefit pensions are becoming much less significant. So in a defined contribution scheme, as I'm sure everybody's familiar with, people pay money in, it generates their own fund from which they will draw in retirement to finance consumption. A defined benefit scheme is a different design. In the UK, in the past, it's been the dominant form of private pension saving, where it was explicitly linked to working for a company who would themselves make contributions alongside the workers' contribution, and the payment in retirement would be linked to how many years service in that company people had, and not linked directly at all to the rate of return on the assets. What that meant was that defined benefit pensions were considered as safe, in the sense that individuals were protected from fluctuations in asset values. Defined contribution pensions are different, because the risk of assets underperforming and the benefit of assets overperforming directly affects how much pension income you will get from a defined contribution scheme. I want to think very briefly about some of the implications of that. I'm going to skip through a few things I was going to say about the different kind of portfolios of assets held by defined benefit schemes and defined contribution schemes, except to note one thing, which may be specific to the UK and therefore of less general interest, which is that defined benefit pension schemes, which will become much less important in the future, a very high proportion of their assets were UK government bonds. That has been exceptionally helpful to the UK government, particularly in recent decades, when, as in many other countries, the stock of government debt has risen very substantially. And it's been a great help to the UK government, which has had to sell vast numbers of UK government bonds every year for at least 15 years, that there was a willing buyer of those bonds. They are not going to be there to the same extent in the future. But my main point, incidentally, well, let me skip on for now, because we're running a little bit short of time. So I don't want to focus too much on the demand for government bonds, but I do want to spend just a couple of minutes, if I will, on just this question of whether or not, if we're moving to a system, as I think we are in many countries, where individuals may need to directly invest in and save in pensions to a greater extent than the past, and that those pensions overwhelmingly will generate financial risk to individuals depending on what kind of financial assets they choose to invest in their personal pensions. What might some of the implications of that be? One thing that people say in the UK is that this is very unfortunate because people will be forced to take financial market risk in a way that hasn't been true in the past, because most pensions guaranteed an amount of money and the risk fell back on the company that people worked for if assets underperformed. I think in some ways I agree with that, but in other ways I think it's misguided. I think it's misguided in a sense because what has happened in the UK and maybe in other countries, I think in the US to some extent as well, is that when assets did underperform and when life expectancy increased in a way that people hadn't anticipated, which hugely increases the cost of providing the pensions, it's true that the cost of dealing with that fell on companies, but of course companies are owned by people, and companies employ people and they do investment. So if there's a problem for companies, private sector companies, the idea that households can avoid the implications of that is of course economically illiterate. That will fall back on individuals, and many companies in the UK, I think similar things have happened in the United States, when pensions, company pensions have turned out to be far more expensive than they thought, have got into financial trouble. They've cut back on employment, they've reduced wages in some cases, they've employed fewer people, they haven't invested so much, and all of the implications of that fall back on households. So I think it's somewhat misguided to think that if this older style of pensions, which has been very significant in some countries, the UK and the US being two, where companies guaranteed returns and took the risk then of financial market fluctuations, the idea that pushing more of that onto households represents a massive increase in risk. It's just a more distributional effect. But nonetheless, it has consequences. And I want to perhaps finally offer a couple of thoughts just on that, and as to whether or not a slightly different form of pension saving, popular in some countries already, Canada would be one, which allows intergenerational risk sharing in a system which is funded and where individuals do build up their own pot of savings, might substantially reduce the risk of financial market fluctuations. In other words, is there a way of kind of spreading financial market risk so that if you're unlucky and just as you are coming up to retirement, you have your pot of savings, it's invested in assets, suddenly there's a big sell-off in the asset market, and you find that your retirement pension is 25% lower than you'd thought. Of course, there's the flip side of that, which in some ways is symmetric. I mean, you could just get very lucky just before you retire. Bond yields fall, you're holding lots of bonds, bond prices go up a lot, the stock market booms, and suddenly you've got a windfall and your retirement pension looks like it might be 25% higher than you thought just a couple of years earlier. If you could devise a scheme of sharing between this generation and future generations, that might generate some substantial benefits to everybody, a much more favorable risk-return trade-off. Might that be something already, to some extent, a feature of the Canadian and the Dutch pension system? Might that be more widely of benefit? Let me just show you briefly a couple of calculations to illustrate the potential gains from a form of intergenerational risk sharing. I should explain what these rather strange pictures show. What I've done here is done a sort of counterfactual historical simulation of what kind of pension people might have received if at the point at which they enter the labor force, you can see this chart goes back a long way to the late 19th century, and it stops about 40 odd years ago, a bit more than 40 years ago. What it does is it says, let's imagine somebody entered work, and this is for Australia. They invested simply in the Australian stock market and the Australian bond market. And they put a certain proportion of their salary every year into that, and that accumulates over time. And at the point when they reach retirement, I'm going to assume they work for 40 years, and then they buy an annuity. They buy an annuity based on what government bond yields were at the date 40 years after they started working. They buy a 20-year flat real annuity, so a relatively safe way of generating, sorry, I shouldn't say 20 years. I mean, they buy at retirement an annuity that will just pay a flat amount of money for however long they then live. And the chart just shows an index of how much you would have got as a pension, depending on when you entered the workforce and the points at which you were feeding money into your domestic financial markets. And it fluctuates a lot, you know, from an index level there of, you know, 3 for someone who entered in 1890 or something, down to less than 1, and then coming back up, because there's been huge fluctuations in the market. I've done it for quite a few countries. There's Belgium. And they don't all look the same. I mean, sometimes you'd have been a lot better off to be, in a sense, born earlier, and the stock markets and the bond markets, you've got your timing right quite by luck. There's the UK, and again, you know, the range of outcomes there is enormous, from 2 down to 1/2. So it's a 4-fold difference, depending on get your timing right. There's the US, and it's all over the place. So I show you those charts merely to illustrate the potential for intergenerational risk sharing to generate a much better trade-off between risk and return is potentially very large. But and those kind of charts are the things that have made some people, certainly in the UK and in the UK government, believe that what's called collective defined contribution schemes may be the answer to some of these risk shifting problems, which would help the fiscal situation because the government would take on less pension cost risk and push some of the risk to households who may be better able to deal with it if they could share risk intergenerationally. What's not to like about that? The following is what's not to like about that. It is that unless you force future generations to play this game, unless you force the young to stay in a scheme that may have just had a nasty shock to asset values, which would enormously influence older workers who are about to retire and see the value of their assets fall a lot, unless you can force the young to compensate them by having some of the flow of new contributions from younger workers actually compensate older workers because they just lost a load of money on their stock of assets, then the thing will fall apart. And that means that you couldn't rely on this scheme working when people have choices over whether or not they want to join it or not. I mean, if you're a 20-year-old or 25-year-old, you're just starting out working, you can join a scheme like this. You may be encouraged to by the government. There's just been a huge fall in the stock market and the bond market. The 55, 60, 65-year-olds who are about to retire, if they didn't get some compensation now for the fact that their assets have fallen a lot in value, they're going to be taking a big hit. So the scheme will be designed then to mean that, well, we can help, the younger can help them now by paying some of their contributions into the fund, which doesn't go into their own assets, but helps compensate the older for the bad luck they've just had. Well, if you're a 25-year-old, you might think, you know what, I don't think I'm going to join this scheme. Not now. Now, you might want to join the scheme if there'd just been a boom in asset prices. And I think it's quite difficult, actually, to make these so-called collective defined contribution schemes work unless you make them compulsory, or they happen to start off being extraordinarily overfunded. So there are problems ahead, I think. There are problems for governments, obvious and relatively well understood ones, from the affordability of state pensions. The CDC route, which is collective defined contributions, generating apparently wonderful gains from reductions in risk by sharing it intergenerationally, I think is problematic. But I very much echo something that Andrea Scott said. It's easy to focus on problems with aging populations. Of course, these are problems that come from success. They're the success in having people live longer, and to a large extent, longer years spent in reasonably good health. And it's certainly not the case that these kind of affordability and old age questions have to all be solved through pensions policy and taxation and fiscal policy. The good way through many of these problems, just to finish on a positive note, is for people to flexibly work a bit longer than people have done in the past. And the good news here, of course, is that the physical demands of work have never been less than they are today. This is not a world where the majority of people do physically hard work, which becomes very difficult when people are past 60 or 65. And so I think there is no reason to feel sort of despondent about facing issues that come from demographics, but they do present nonetheless fiscal and financial market issues that I think are worth thinking about ahead of when they actually begin to have their most severe effects. I'll stop at that point.
Thank you.
Shall I stand up here for a minute in case anybody wants to ask a question?
Yeah, thank you so much. So we will break for coffee break now, and we will meet at 11:20 sharp, and we will have the opportunity to have David for the panel session
That's
again.
true.
So
Okay.
Thank you so much.
Thank you.
We will start this part of the session with Andrea Ferrero, who is the Professor of Economics at the University of Oxford, a Senior Research Fellow at Trinity College, and a CEPR Research Fellow. After graduating with a PhD from NYU in 2006, he was an economist in the research department of the Federal Reserve Bank of New York for 7 years. He held visiting positions at various universities and central banks. He is currently an academic consultant for the Bank of England. His research has appeared in top professional publications, including American Economic Review, the Review of Economic Studies, and many more. Recently, he has been studying the determinants of law of real interest rates, the international transmission of financial shocks, and the interaction between different policy tools. So we are very happy to have Andrea with us today. Thank you.
Well, thank you very much for having me. It's a great pleasure to be here. So this joint work with Carlos Carvalho, Felipe Mazin, and Fernanda Necchio, and the usual disclaimers apply. So this paper is really about one of the themes of the conferences. So it's about the effects of demographic trends on real interest rates. Well-known fact, I guess, for most people in the audience is that real interest rates have been coming down pretty much since the early 90s, at least until the COVID pandemic. So here what I'm plotting is the median ex-ante real interest rate for about 20 OECD countries and some dispersion across countries, which has also been falling. So that's the other fact that is going to be part of the focus of our paper. Demographics have been one of the candidate explanations to account for this secular decline, and including our previous work and many other people, including some of you in this room. What we want to do in this paper is to think about openness and the interaction between demographic trends and imperfect capital mobility. So what we're going to do is two things. We're going to first develop a model that allows us to think about this question in a kind of a structural way. And I'm going to show you that demographic trends account for about a third of the overall fall of interest rates in our model. And the changes in financial integration that, I'm going to tell you how we measure specifically later, account for pretty much the whole decline in dispersion observed in the data. And then we're going to turn to the data and try to test empirically the importance of demographics in conjunction or in comparison with other forces that have been highlighted in the literature. I'm going to show you that openness and global factors account for, play a pretty important role empirically, but domestic demographic variables remain significant. I'm also briefly going to highlight that one theme that David and others before me have already touched upon. Pensions also are important, although it's not the main focus of our paper. And then, if I have time, I'll also talk briefly about the recent rise in interest rates. Otherwise, I'll defer that discussion for later during the panel. Let me just skip the literature. I just want to say briefly that there's a lot of work ongoing. We contribute to this discussion of the role of demographics in open economy, but also later on, when we get to the empirics, we take into account other potential competing explanations. So briefly about the model, it's a model that works in the tradition of life cycle frameworks, but it's fairly simple. Basically has two types of groups, workers and retirees, and builds on this paper by Mark Gertler written in the late 90s. On the original Gertler's model, basically what we add is time variation in demographic factors, and we introduce portfolio holding costs that are going to introduce some degree of imperfect capital mobilities. So in each country, there's going to be workers and retirees, as I said. Workers face some idiosyncratic risk of retirement, and then everybody consumes the same goods. And then, there are assets through which people can save, which are issued by either the government or accumulated through capital. And there are also claims on foreign capital and foreign assets. And then, workers during their lifespan can retire. Once retired, they face some risk of death. The rest of the model is extremely standard, it's a very classical supply side. And then there's the government that supplies these bonds, has to fund some spending, and can raise taxes on the private side. So, as I said before, the demographic structure is extremely simple, very stylized, but allows for a lot of tractability, which is useful when we go to this multi-country setting. So, in each period, there's a new mass of workers who are born, and then they remain in the labor force with some probability, and they otherwise retire. Once they retire, with some probability they survive, and with a complementary probability they die. So this structure gives you basically two key demographic variables that you can relate sort of to the data. One is the growth rate of the labor force, which is this variable n. The other is, like another talk before me, the dependency ratio. That is the number of retirees relative to the number of workers. And as you can see from the second expression, this dependency ratio is a function of both the retirement age and the probability of surviving, as well as the denominator, the growth rate of the labor force. So there is a way to kind of go to the data and back out probability of surviving from the observed dependency ratio, given the value for the growth rate of the labor force and some assumption on retirement age. I'm going to briefly go over the structure of the problem, just to illustrate where the key departure from a more standard framework occur. So let me start with the problem of a retiree that maximizes the present discounted value of their consumption, and subject to a budget constraint where they can accumulate some financial wealth, which is denoted by A. Retirees receive some pension benefits, which are denoted by E. and then consume and then can accumulate new assets. The twist relative to a more standard framework is the presence of these portfolio holding costs, which are parameterized by that variable lambda there highlighted in red. So if lambda is 0, basically there's no portfolio holding cost, and net foreign assets are perfect substitutes across countries. What we're going to do is we're going to infer this cost from observed net foreign asset position, and so that inference is going to give us some measure of imperfect capital mobility. That eta that enters the specification of this portfolio holding cost is basically the share that a country holds against other countries. And then, as is standard in some papers, at least in this literature, retirees discount the future, taking into account the probability of surviving, and they also turn their wealth to mutual funds that gives them an extra return in the case of survival. The worker's problem is similar. Clearly, the worker needs to take into account the probability of continuing as a worker or of retiring. Faces a similar budget constraint on the expenditure side, so consume and accumulate assets. On the source of funds, they also receive returns, but there's no mutual fund ensuring for the probability of retirement. They receive wages and pay taxes. Okay, so one simplifying assumption that this structure of portfolio holding cost buys us is the fact that the portfolio shares are actually independent of ages. So it's very easy to keep track of the distribution of wealth. You can also see here that if that parameter lambda is 0 for all countries, then you have perfect return equalization. And so really here is where lambda plays the role of generating some dispersion in returns that we can relate to the data. And then the same condition of portfolio shares being independent of age holds for workers as well, so that facilitates greatly aggregation. And so basically, we only need to keep track of the distribution of wealth between retirees and worker as an additional state variables that fully characterizes the problem. Similarly, because probability of surviving are independent of age, aggregation within groups are also extremely simple. So we can write marginal propensity to consume for both retirees and workers, and then aggregate their consumption function. So essentially, we have one aggregate level of consumption for retirees and one level of consumption at the aggregate level for workers. So for retirees, that level of consumption depends on their financial wealth and the present discounted value of their pension benefits. For workers, also, their consumption depends on financial wealth, as well on their wages net of taxation, which is what I'm calling here human wealth, and the present discounted value of pension benefits that they expect they will receive once retired, although that present discounted value is different from retirees because of the difference in discount. As I said, production is extremely simple, very classical. Firms produce output with a technology that combines labor and capital. Technology grows exogenous at some rate X, and capital accumulates through investment. And then there is a government that issues bonds. These bonds are issued to finance government spending, spend on benefits that go to retirees, net of taxes, and some additional costs that depends on the way in which this portfolio holding costs are collected. Finally, and this is just accounting, you can define the assets that residents of a country hold as the sum of capital and bonds net of the claims that the rest of the world owns on your own country. And then characterize the evolution of net foreign assets, which depends on the returns that your country makes, the returns that your country has to pay on foreign claims, the trade balance, which is that second term there, and then the last two terms are just this portfolio costs that are collected and paid across countries. And finally, the global asset market has to clear, so the net foreign asset position as a whole has to adopt to zero. So that completes the description of the model. Let me just tell you how we calibrate the model. We use a 3-country version of this model. There's going to be a big rest of the world, which is the last column in this table. And then there are going to be 2 small economies. And the 2 small economies are really the interesting one, if you like. There's a young economy that has a high growth rate of the population or of the workforce and a relatively low dependency ratio. And then there's an older economy that has a low growth rate of the population and a high dependency ratio. So, you can think about maybe an old economy like Japan and a young economy like perhaps Australia or Canada. Okay, then the rest of the heterogeneity is kind of calibrated through discount factors and this initial portfolio cost that we calibrate to match some moments of the data, in particular the distribution of returns and net foreign asset position in 1990, looking at the cross-sectional distribution in the data. The other parameters are standard, so I'm not going to spend time on those. I'm going to show you the experiments. Okay, so what we do is we feed into the model the observed and projected demographic transition using data from the United Nations, backing out the portfolio costs in order to match the net foreign asset position, again, in the cross-section. So the blue line is sort of the median real interest rate. The red line is the real interest rate for the country that is relatively young. The black line is the real interest rate for the country that is relatively old. And so you see that up until the global financial crisis, roughly speaking, there is a high degree of convergence. And this convergence occurs from the top for the young country and from the bottom for the old country. And so what we find particularly interesting in going to the open economy and thinking about this imperfect capital mobility is that, with this demographic trend, the convergence doesn't occur monotonically. So you have countries that, upon opening up to the rest of the world, experience, at least for a while, an increase in real interest rates. But then, over time, demographics take over. Basically, the trends are the same everywhere in the world, and so interest rates, continue to fall. The dashed vertical line denotes 2020, so anything beyond that is sort of a projection which is driven by the demographic projections themselves. In a previous paper, we've done this exercise decomposing the 2 channels that we repeat here. So on the left, I'm showing you what happens in a counterfactual world in which we keep constant population growth, and we only change the implied life expectancy. And you see that the results are not terribly different. On the right, instead, we do the opposite exercise in which we fix we fix life expectancy, and we only change the growth rate of the labor force. And here you see much more of a difference. What this is telling you is that in our paper, in our model, the results are mostly driven, so this decline in interest rate is mostly driven by the increase in life expectancy. In this other counterfactual, we instead fix the degree of financial integration at the initial level. And so what you see in this case is that we don't have that non-monotonic convergence anymore. So demographic exerts sort of the same pressure everywhere in the world, and real interest rate fall kind of in parallel without any other changes in the degree of dispersion. And so this point is going to be important for then informing our empirics, because when we get to the data, as I'm going to show you in a minute, we're going to interact variables, including demographics, with some measure of financial integration across country. And so that's that specification is going to be inspired by this picture. Okay, so before getting to the data, the last point I want to make is that although we focus on demographics, our model includes some of the other factors that have been discussed in the literature as potential drivers of real interest rates, and that we're going to bring in the empirical analysis. So here we do just a very simple comparative static exercise where we change one factor at the time, and we feed in the same demographic transition to assess sort of the sensitivity of our results to different degree to variation in this factor. So you see the factors listed here. I'm not going to go one by one over them. The main point, I guess, that I want to make is that you see that the differences are particularly pronounced earlier on, right? Whereas they disappear, they tend to disappear over time. So I just report here 2 columns, differences relative to the baseline in 1990 and in 2020. And the reason why the differences tend to disappear over time, it's because financial integration increases, and so these factors are, much more important when a country is less integrated with the rest of the world than when it becomes more integrated. Okay, so let me turn to the empirical analysis. As I said, we try to work with a specification that relates to the lessons from the model. So we regress real interest rates on demographic variables, controlling for integration, and also for these other factors that have been discussed in the literature I just mentioned briefly in the previous slide. We use data from 79 until 2019 from a number of sources, and we have 19 countries. Panel is a little bit unbalanced, but at least in some specification has pretty good coverage. So here's the specification that we use. We use an error correction model to focus on long-run movements in interest rates. And the other thing that we do is we focus on the global interest rate as a summary of all the factors that can affect a country from the rest of the world. And we do that because otherwise we run out of degrees of freedom if we include all the factors one by one. So we summarize all the global forces in one indicator, which is this measure of global interest rate, which we construct as the average of real interest rate from other countries. And secondly, as I mentioned, we interact this factor and the domestic factor with the complement of financial integration, which is a measure which you construct from Lane and Milesi and Ferretti, and we transform in an index that goes from 0 to 1. So a measure of 0 would be a country in autarky, right, where it's completely not integrated with the rest of the world. A measure of 1 would be a country that is fully integrated with the rest of the world, so that its real interest rate is the same as the world real interest rate. So here are the results. It's a big table. We go through multiple specifications. I'm gonna just highlight a couple of results for you. So the first is that the global rate is significant in all specifications. So basically, this captures the movement of interest rates across countries, and the coefficient is, relatively stable across specification. The second point is that once you control, especially for fiscal policy, then you get domestic demographic factors to enter the result with the expected sign, meaning higher life expectancy has a negative effect on the real interest rate, whereas a higher growth rate of the labor force has a positive effect. We don't find a significant effect for TFP growth or government debt in a couple of specifications. The effect that we do find systematically across specification to be positive and consistent with intuition is this effect of pension spending that I mentioned earlier. So higher countries with more generosity in their pension tend to have, on average, higher real interest rates. Let me just put this a little bit in context by giving you the composition of these effects in the full sample on the left and post-1990 on the right. So in order to calculate these numbers, we do sort of a back-of-the-envelope calculation. Basically, the reason is that the coefficient on each country that we estimate is interacted with this degree of financial integration, which in a sense makes it time-varying. So in order to get a sense of how important each factor is, what we do is we take the change in each factor, multiply by the average degree of openness for the sub-period, so either for the full sample or post-1990. And then we multiply that number by the estimated coefficient, and then in the end we take the average across countries. And so on the left you see that the global rate, life expectancy, and the growth rate of the labor force play, roughly speaking, a similar role for real interest rates. In all cases it's negative. Whereas pensions are really the factor that contributes more systematically to keep real interest rate higher. And there's also a little bit of a role for government debt. On the right, you see that this relative importance has changed over time. So when we focus on the post-1990 sample, we find that global factors are much more important, and that sort of suggests, that financial integration has increased quite substantially post-1990. We still find some role for demographic factors at the country level, and also on the positive side for pension spending and government debt. The last point that I want to make, well, actually 2 points. So one point is recently, as you probably know, real interest rates have gone up in quite a lot of countries following the pandemic. So in a recent San Francisco Fed economics letter, what we did is we used our model to compare changes in drivers of real interest rate pre and post-pandemic. Obviously, the post-pandemic sample is very short, so take these numbers with a grain of salt. And so we split the drivers in global factors, aging, which is just a summary of demographics, TFP growth, and fiscal spending, and we focus on the United States for this exercise. And so in blue, you see the factors that pre-COVID, and in red, you see the contribution of the factors post-COVID. And you clearly see a significant change here in the case of the US. So from negative, the contribution of global factors have become mildly positive. Population aging has slowed down a little bit, but the big change is, is the positive contribution in fiscal spending. So the increase in real interest rates seems to be driven by the increase in spending that has occurred post-pandemic. The last point that I'm going to make just before concluding is that controlling for financial integration is actually quite important. So what we do is sort of run an quote-unquote naive version of the same regression without controlling for financial integration. In this case, what we find is that while life expectancy still enters with a negative sign in all specifications, other coefficients are much less stable. So for instance, the global rate is significant in some specific specifications, but not in others, but it sometimes enters with the quote-unquote wrong sign, and the same is true for the growth rate of the labor force. So sometimes, the empirical literature, as mentioned earlier in one of the presentations, struggled to find systematic effects of various drivers of real interest rates. And so one reason, in our view, has to do with the fact that it's important, especially when you work in a cross-country type of environment, to think about how these various forces interact with financial integration. So let me conclude here so that I have a couple minutes for questions in case. We use a model and empirics to study the dynamics of real interest rates to account for the decline since 1990 and the decline in dispersion. We developed both a model and empirics that highlight the importance of financial integration. Remote is not working anymore. Both highlight the role of financial integrations global factors as well as domestic demographics. Thank you very much.
We have a few minutes for questions, if you have any. Yes.
Thank you. Very just looking at the regressions at the end, you've got life expectancy, the negative coefficient, and you've got the positive coefficient. But over the last 100 years, we've seen decline, not worth any decline. I look from the early 1990s, the rise in participation. Have you looked at equating those two to see what happened? Active. It looks to me like the coefficient of the workforce is greater than the coefficient. What's going to happen with interest rates and simple growth model? Workers, I just wanted to look at the coefficients.
So in the model, there was that table. In the other paper we wrote in 2016, we also play around a bit more with retirement age. Clearly, retirement age has quite significant effect in modulating the impact of demographics on real interest rates. In that paper, we did sort of some, again, simple calculation to figure out how significant the current changes that are discussed in practice. And we found that if you implement those changes today, they're not going to have a massive effect. But if you add index retirement age to life expectancy, then you could have almost offset completely the negative effect on real interest rate. Let me just say, in the data, we try with a specification including retirement age as an observable variable, and it was never significant. And our understanding is that in the data, at least the official numbers, do not display enough variation to pick up anything. Now, you'd say, well, maybe if you use effective measures of retirement age, there is more variation. And so that, I don't know if those measures are available. It could be important.
No, I mean, there's a nice Goldman Sachs piece recently which shows no correlation between the rise in employment of older workers and countries that have changed the state pension age. But I think if you look at the change in the participation rate from 50 onwards, then you'll see that's a big driver of the growth of the labour force. So just curious to see that.
Yeah.
One question for David Miles, actually. I don't think that, David. One question for your presentation, if possible. Yeah. You argue there that whenever we have, let's say, defined contribution measures there, you are arguing in favor of collective contracts or something like this, but to my opinion, at least, to my view, the vast majority of these things are collective, aren't they? Therefore, this is a definition. What exactly do you mean by, perhaps I missed it when you were presented, but the vast majority of all these in the defined contribution kind of schemes that we have there are collective, aren't they? They are not individual plans.
I struggled a bit to understand the question.
You were arguing in favor of defined contribution to being collective. What is the definition of collective that you have there?
Collective defined contribution is where individuals pay money into their own personal account, but the return on that can be adjusted up or down relative to simply reflecting the value of the assets when they retire, depending on whether some of the money needs to be allocated to people who have had bad luck on just retiring when the assets may have fallen in value. So there's a degree of cross-subsidy between people of different generations, which could either mean that younger people get a better deal or a less good deal, depending on whether people who are older than them lose or gain money just before they retire. So that there's a mechanism for distributing assets between the young and the old, depending on the rates of return that the old have experienced during their life saving. If everybody earned, on average over their lives, the expected average return, then there would be no cross-subsidy. But if the old were very unlucky, and there was a big sell-off in the markets just before they retired, the younger members of the scheme would find that instead of all their money accumulating in their own asset pot, some of it would be used to pay higher pensions to the old who had had a bit of bad luck just before they retired. That's the way the scheme's supposed to work. So it's sharing the risk between generations. I have to say, I wasn't advocating this because I think it is potentially unstable, because the young could simply decide, well, we're going to pull out now. We're going to stop doing this because we're getting less than the true return on the money we're putting in. And they would pull out, potentially, exactly when the old needed the insurance from the cross-subsidization. So I think it's potentially unstable, but it is a type of pension scheme that is advocated by some people. It happens to be now advocated quite a lot in the UK. But I'm not saying it's the answer to the problem. I think it is in some ways a flawed system.
Thank you.
Can I?
Yeah, we will have a panel at the end so we will have more opportunities to ask questions. Thanks a lot, Andrea, for your presentation and handling the questions. Now we are moving to Adrien, who is an associate professor of economics at Stanford University, a research associate at the MBR, a research fellow at the CEPR, and a senior fellow at the Stanford Institute for Economic Policy Research. He's a member of the Council of Economic Analysis to the French Prime Minister and a foreign editor at the Review of Economic Studies. Adrien received his PhD in economics from MIT in 2015 and has been a visiting fellow at Princeton University and the University of Chicago. Adrien's research explores the aggregate implications of heterogeneity, how to use microdata to improve our understanding of macroeconomic dynamics and the effects of policy. He has studied various topics, including monetary policy, fiscal policy, and sovereign default, as well as demographic change. He was awarded at the NCF Career Award in 2021 and a Sloan Research Fellowship in 2022. We are looking forward to his keynote speech. Thank you.
Thanks so much for a kind introduction. It's great to speak here. So I'm be talking about a paper that echoes in a lot of the previous papers that we've seen. You'll see there's a lot of complementarity between what I'm going to talk about and what Andrea in particular has been discussing. So the paper thinks about the macro consequences of demographic change for aggregate wealth accumulation, interest rates like R star, and global imbalances. So the starting point is in this type of chart that we've seen a lot this morning, showing how much the world population is aging. So this shows you the share of the population age 50 or above in 5 large countries. And what you can see from this graph that everyone knows here is that the world population is not only aging, but it's doing that at a very uneven pace. Right? So there's countries like Japan, whose demographic transition is almost over, and then countries like China and India that still have a long way to go. And so if you look over the past couple of decades, what we've seen is big increases in wealth to GDP ratios. So this famously documented by Thomas Piketty and co-authors, with some acceleration in the recent decades. Very, very big increases in the share, the ratio of W over Y, wealth to GDP. At the same time, we've seen declines in rates of return. Right? So Andrea showed this a little bit. So this goes back all the way to 1950. So if you look at the total return on wealth, that's actually something that's kind of been smoothly falling for the past few decades. The safe return, which Andrea was focusing on, that has a very pronounced decline since the 1990s. In this paper, we're going to focus on the red line, the total return, but we'll also have a little bit to say about the safe return, and so the spread between the kind of total and the safe rate. And then the other thing we're interested in is this rise in so-called global imbalances. Right, so there's been financial liberalization since the 1980s, and you've seen very big increases in net foreign asset positions in some countries, like Japan or Germany, and then very big declines in net foreign asset positions in countries like the US. Right? So the premise of the paper is, well, demographics could help maybe explain some of these macro trends. We think there's broad agreement among macroeconomists that there's some causal link there, because an aging population saves more, and so as it saves more, it's going to push down on rates of return, and it's going to increase wealth to GDP ratios. And then because there's unevenness, so some countries age faster than others, you can also explain global imbalances. So you can explain why some countries end up saving abroad as a result of fast aging. But on the other hand, there's not really a consensus in the literature about how much, right? So Oscar showed some of these papers this morning that had some disagreement over the effect of aging on interest rates. And if you look across the literature, you're gonna, if you ask simple questions like how much did population aging between 1970 and 2015 contribute to the decline in our star, some papers will say kind of some small number, less than 100 basis points. Some papers will have some very large number, like over 300 basis points. And so we wanted to think about, well, how do we discipline those effects? What's in the data that could be informative about how big this effect might be? And then if you look going forward, some of these models actually can disagree even on the direction, right? Even not on the magnitude, but just the direction. Needless to say, this is critical for the current debate on monetary policy normalization. So the big question about where our star will end up and what that will mean for long-term interest rates. And so you have in particular this influential view that these trends will revert, and so Larry Summers kind of put it, well, I think kind of recently in an interview, he said, once people have aged and they retire, then they start to draw down their savings and spend. And so he says, we're going to make a transition from more saving because of aging to less saving because aging has happened. And so this idea that the effect on the overall savings is going to revert and start pushing up on interest rates is something that's kind of very influential, we think, in policy circles that has been pushed by Charles Goodhart in this book, The Great Demographic Reversal. And so this is kind of a hypothesis out there that we want to see how much data, that we can bring some data to bear on it. So the paper is going to develop a sufficient statistic type of approach to think about this question. So we're going to say, okay, let's just write down multi-country general equilibrium overlapping generations model, so a little bit similar to what Andrea wrote down, and then think about characterizing the effect of demographic change on wealth to GDP ratios, interest rates, and net foreign asset positions, and we're going to show that that depends in a baseline model only on the age profiles of wealth, labor income and consumption, as well as demographic projections. So that's kind of things that you can take from the data, together with two parameters, the so-called elasticity of interchangeable substitution, and the elasticity of substitution between capital and labor, which you might think of as primitives of the model. Right? And so based on these two parameters plus all of this data, we can kind of implement our framework. And then when we do that, we're going to find that, yes, demographics has pushed down our star to date, so that's consistent with a lot of the literature, and we can quantify how much depends on sigma and eta. And then we're going to soundly reject the great demographic reversal hypothesis going forward. So we're going to show that there's not actually kind of in the class of models that we study, there's nothing to that hypothesis. We're going to clarify why that is. Okay, now this is going to be a baseline model that's going to have kind of a lot of richness in some dimensions, but not in others. And so in particular, Andrew has been talking about the importance of longevity, right? So in our baseline model, actually longevity, it will be fixed. So we won't actually have improved longevity as people age. It'll just be a compositional effect of demographics. And so we can start thinking about how much deviating from the baseline model can change our conclusions. And so we're going to have a little bit of that, and then Bertrand later is going to talk about some of the work that the IMF has done on this question. Okay, so let me start talking about the model. So the model is an overlapping generations model with demographic change in multiple countries facing R. So similar to Andrea, it's a multi-country OLG model. But it doesn't have the portfolio costs that he was talking about. So this is a globally integrated financial market. So this is abstracting away from these types of frictions across countries. On the other hand, it's going to have a lot of richness describing the demographics, because we want to be able to confront the data on how many people there are in each age, as well as what they do at each age. So the way we describe demographics is kind of with this rich specification where we count all the births at any date, right? So N0T is the number of people that are born in each date. And here I don't have country subscripts, but all of these demographic parameters are also country specific. And then we have a sequence of mortality rates, right? So at each age, you have a likelihood of surviving to the next age. That's the phase. In the baseline model, that's going to be constant. So this is what I was saying about we don't have a longevity effect here in the model, right? So there is a certain mortality curve that you're facing, and that's actually constant over time. We can relax that later. And also, we don't have migration. So we're talking this morning about the importance of migration for population structure. So in the basic model, we don't have migration, and then we can kind of relax that assumption and add cross-country migration. And then production in this model is completely neoclassical. And so you have an aggregate production function that takes in capital and effective labor, so a mix of labor from people of different ages, where there's different kind of effectiveness or productivity of the workforce at different ages. And there's a certain elasticity of substitution eta, which governs the substitution between capital and this effective labor bundle. There's constant growth rate of labor augmenting technology, and so that is going to drive baseline growth in GDP per capita, and perfect competition with free capital adjustments. So like I was saying, this paper does not focus on these frictions across countries. So just thinking about the overall determination of, if you want, the kind of global rate of interest. And there's a government in this model, and so what the government does is, well, it runs kind of a tax and transfer system, where there is, in particular, a pension system. And so on the right of the government budget constraint, you have the taxes that it takes in. And so the taxes depend on the number of people that are working at different ages, because they make different amounts of labor income. And what does it do with these taxes, as well as the new bonds that are issued? Well, it pays off the existing bonds. It pays for all of the transfers that could be age-specific, so think in particular the pensions, and it pays for government spending. And so as the population ages, you're going to have more old people, fewer young people, and so there's going to be fewer people paying into the pension system and more people that are getting paid benefits. And so we have to specify the fiscal rule, which is the way in which the government adjusts in the face of these pressures. And so in the basic model, so this is this assumption highlighted in red here, we're going to assume that the government balances the budget by just changing government spending. And so that's going to allow us to derive a bunch of very simple results, because government spending is going to be neutral from the perspective of agents. And then later we can start thinking about what happens if the government adjusts by, say, reducing pensions, increasing the retirement age, and so on and so forth, which is going to alter life cycle savings. Right? And so it changes the G, and then it targets a constant debt to GDP ratio, right? Which are sort of simple neutral assumptions for what the government's doing. So the way we specify the problem of agents here, so this has all this richness that's typical of kind of quantitative life cycle models. So we have heterogeneous agents that are born in each cohort K, and they're solving this life cycle problem. So understanding that as they age, they face different mortality curves, so that's the phi j. They can face age-specific discount factors, so that could capture all sorts of reasons why people save differently at different ages. You think of having children makes you want to save more. Maybe having late in life risks really increases your marginal utility of consumption in old age, so it makes you want to save for retirement, for old age because of this, because of these health reasons. And then there's classic life cycle reasons in the model, and so you have you make different amounts at different ages. So because you'll make less when you're retired than when you're working, you have this life cycle motive for saving. And then finally, there's a precautionary motive here because agents face an insurable income risk. So they can buy these annuities, which insure them against the risk of death, but they can't make that specific to their particular labor earnings. Right? And so they face an insurable income risk and borrowing constraints, which is another motive for saving. And so agents have all of these reasons for saving in the model, and we're agnostic about which reason drives life cycle behavior. We're going to be thinking about matching the overall amount of asset accumulation and income at each age, and so we don't want to take a stance on the reason why people save. I have here in red this assumption that agents hold annuities, so you might object to that and say, well, we don't see that much annuitization in the data. And that's right. So once you start thinking about what are the non-annuitized ways of saving, you have to start thinking about bequest motives and also how the wealth gets redistributed, which is once people die, where does the wealth go? And so we're going to think about that in the quantitative model. Okay, so the definition of equilibrium is completely standard given this. So this is a frictionless international equilibrium. So integrated world equilibrium, where in an equilibrium all individuals optimize, the firms optimize, and then global assets market clear. So think of the determination of world interest rates as, well, everybody has their own reason why they want to save, so that creates a total demand for assets once you sum across all agents and all countries. This is the total amount of wealth that people want to invest. And then on the other side of the market, there's a total amount of assets that are supplied by the market, and that comes from the firms, right? So they have this capital stock, and then there's governments that supply these bonds. And so the balance between supply and demand is going to determine interest rates. Yeah. So we're going to think about analyzing this model first by considering a small open economy, aging alone, where the rest of the world is at a steady state. So this is immediately fixing the interest rate and just saying, well, what's the effect from aging on wealth accumulation and net foreign assets, and then later we'll think about a global integrated world where all countries are aging at the same time, so the realistic world where there's also going to be an adjustment of the interest rate. And so when you think about just that small open economy, you think about the problem that we wrote down, there's actually a very simple result that you can derive for the evolution of the wealth to GDP ratio, and that result just says, well, actually, if you think about the model we wrote down, that's a model where people make the same decisions over time, right? And why is that? Well, because apart from growth, which is something that can normalize everybody's problem, so once you start thinking about detrended by growth, the problem that all agents are facing over time is the same. Right? And so as a result of that, they decide to do the same thing at each age. And so demographics doesn't alter people's decisions by age. All it does is it alters the number of people of different ages. Right? So demographics act in this model completely via a compositional effect. And there's two compositional effects to think about if you think about wealth to GDP. There's a compositional effect on wealth accumulation, which is going to say, well, as people age, there's more old people, and older people have more assets, so that's going to push up on W. And then there's a compositional effect on labor supply. And so here, as people age, there's fewer people in the workforce, and that's going to push down on GDP. Right? And so these two effects combined push up on wealth to GDP, and that's kind of the basic effect in this model, which is purely compositional. Okay? And so the nice thing about this is the compositional effect, we can just read it off the data, because we could just use demographic projections for a number of people at each age. And then we can look at what people do at each age in a given cross-section even. And that's actually the valid thing to do to carry forward to do counterfactual simulations of what will happen as the world ages, okay? So of course there's strong assumptions that are built into this, but once you buy our assumptions, you can actually just do this purely from the data, okay? So So what we're going to do now, which is just go and measure these compositional effects. So we do this by putting together surveys for 25 different countries together with the UN World Population Projections. And so we measure how much people accumulate assets at each age, how much people make in labor income at each age, and then we just roll forward population projections using the formula that I wrote down to make so this is a prediction, holding interest rates constant, how much will each country accumulate in wealth, right? What's the projection for wealth to GDP ratio? So this is in logs, so this is in percentage points, if you want. So this is looking at the United States. What do we get from this? So this is compositional effect alone on wealth to GDP. So remember, the wealth to GDP ratio today is about 500% of GDP. So this says, well, if you go back to 1950, it would have been 25% less just from composition. And if you go forward to 2100, it'll probably be 25% more. Right? So these are really big numbers. Of course, they depend on your assumption for how much the world is aging. And why are these numbers really big? They're big by historical comparisons, meaning they're big even if you compare to the actual data. Well, they're big because of kind of these two effects that I was talking about. So the first one is that in the US, as well as in every other country, the life cycle profile of asset accumulation is steeply upward sloping, starting from about age 40, and going to age 60, and then it's flat, right? So there's very limited decumulation as people age. And so that interacts with an age distribution that I've plotted here for 2015, and that's going to move out to 2100 according to the projections by having a lot more people in old ages and a lot fewer people in young ages. And so if people don't change their behavior as they age, that's just going to massively push up on the demand for assets that in the aggregate people have. Right? So this is the effect from wealth accumulation. And then effects on labor income, well, so again, so this is, again, with this assumption that we don't have a longevity effect, so this is just saying, imagine that people make the same amount at each age, right, without having, so some of the benefits of healthy aging. What will happen as we have this big increase in the ratio of older people relative to younger people is, well, that's just going to push down on effective units of labor provided to the market, so it's going to push down on the labor input and on GDP. So these effects are big, and they're similar in terms of like qualitatively, they're qualitatively similar in every country, right? And so what we get when we do this type of exercise for every country in the world is that we get big increases in wealth to GDP ratios at constant interest rates for every country in the world. And the heterogeneity across countries relates to the heterogeneity in demographics that I was showing at the beginning, right? So the countries that are aging faster have a bigger increase in their wealth to GDP ratio, according to the statistic that countries whose demographic transition is mostly over. There's, of course, also differences across countries in how much people save and how much people work, but those effects are swamped by just the pure kind of differences in demographics across countries, okay? So when you do this calculation for every country, you see, okay, there's a limitation to saying that interest rates are not changing as demographics change, because it's not possible for every country to be saving abroad, right? And so you have to think instead, no, well, as we start all saving together, we're going to be pushing down on interest rates, and so the question is by how much, right? So the rest of the paper thinks about these general equilibrium implications. And so an easy way to understand how equilibrium works in this model is just to think about the long-run steady state. So in the long run, you can think of interest rate determination as the intersection of this world asset demand curve, which is this yellow curve, which is upward sloping in the model, which just governs just how much in the aggregate people want to accumulate assets at a given interest rate. And it's upward sloping because there's a slightly dominant substitution effect. So if you raise interest rates, then people will want to accumulate more assets. the slope of that curve you can actually characterize as a function of this elasticity of intertemporal substitution that I was talking about earlier. And so we developed these sufficient statistics in the paper that relate cross-sectional information plus an elasticity of intertemporal substitution to the slope of that yellow-orange curve. And so that curve is intersecting the world asset supply curve, which is downward sloping in the model. So why is it downward sloping? Well, because as interest rates increase, firms just decide to accumulate less capital. And so that's fewer assets that are provided to the market. And the slope of that curve again is, you can characterize this as a function of a primitive parameter of the model, which is this elasticity of substitution between capital and labor. And so if you represent, in this diagram, the ratios to GDP of asset supply and asset demand versus the interest rate, one thing that's interesting to realize is that as demographic changes, the only thing that's changing here is that the asset demand curve is being pushed out, but the asset supply curve actually doesn't change. Right? So demographics doesn't, in a neoclassical model, doesn't affect asset supply relative to GDP. And so the benefit of thinking about it this way is that you just realize, well, I just measured how much in the data the asset demand curve is being pushed out at a given interest rate by demographic change. And so the only thing I need to know to figure out in equilibrium how much the interest rate falls is just the elasticities of asset supply and asset demand. And so I just told you in the paper, we have these formulas that relate the elasticity of supply and demand to the interest rate. Right? And so what's the equilibrium adjustment mechanism? Well, as people just want to save more, interest rates have to fall, and as they fall, more assets will be provided by the market. So this is, interest rates go down, there's capital deepening. And also, as they fall, people pull back on how much they want to save. And so the balance between these two things, so the ratio of the elasticity of supply and demand determines how much, the sum of these two things determine how much the interest rates falls, and then the ratio of these two things determines how much in total there's asset accumulation in equilibrium. So once you put together, you give me the elasticity of intertemporal substitution, the elasticity of capital labor substitution, you can implement our entire calculation and get an effect on the world interest rate and the increase in total wealth to GDP ratio. That just depends on these two parameters. Right? It's just the data on these two parameters. And so in the baseline, we get a decline in the world interest rate from demographics alone. That's about 100 basis points, and an increase in the world wealth to GDP ratio of about 10 percentage points. Right? So that's much less than the numbers I was showing you, because actually in the model, according to our calculations, at reasonable elasticity of intertemporal substitution, asset demand is actually pretty interest elastic. So as interest rates fall, people just pull back on how much they want to accumulate assets. And so that lowers the total increase in the wealth to GDP ratio. But you still have this substantive fall in the real interest rate. And so here, so this is, like I was saying, this is a model that just has one world interest rate. And so one thing we think about in this context is, well, what if we can distinguish between safe and risky assets? And so we can implement a similar calculation, so where we say there's a certain inherent demand for safety at different ages, and older people save in safer assets. And so we can do a similar calculation using similar types of ideas to then say, well, how much will, once demographics unfold, how much will the safe rate fall, and how much will the risk premium increase? And it turns out that for reasonable parameterization of this model, the total return falls by about the same amount as what I'm showing you here. So it's not a limitation to just focus on the total return. But we can get a meaningful increase in the risk premium. And so that's something that we've recently added to the paper that we're pretty excited about. Another dimension that would be interesting would be to think along the lines of what Andrea was saying, which is, well, what if now there's frictions in investment across countries, and so how much will that dampen the trends in net foreign asset positions predicted by this model? Let me show you these trends. So in this model, this is a frictionless model, so if you want to think about what happens to the net foreign asset position of a country that ages fast relative to that of a country that ages slowly. So remember, there's these different desired wealth accumulations at a given interest rate. Once interest rates fall, all that says is, well, the net foreign asset position of the world as a whole must be zero. So it's just that some countries are going to save abroad and some countries are going to take in the capital flows. And it's the countries that save fastest that end up with a positive asset accumulation abroad. Right? And here there's nothing to stop that mechanism. And so we can calculate how much that predicts for net foreign asset positions for different countries as the world ages by just implementing our formula at each time. And what you see here is these countries like China and India that are aging really quickly, they're predicted according to this model to just have a huge amount of savings abroad, right? And so this is enough to revert India's currently slightly negative international foreign asset position into a number like 100 or 150% of GDP, right? And then countries that are on the other side of this, so that they're not aging as fast, their NFA declines, and so that's true in particular for the United States here. So you see the global imbalance phenomenon driven by aging could be potentially extremely large. Okay? So this is the sufficient statistics part of the model, and so one thing I kind of mentioned is, well, there's lots of limitations here, and in particular, we don't have the healthy aging phenomenon, so we can't actually talk about what would happen to the labor market and to savings as people age healthily, and so then their, say, labor productivity increases as they age. And so you can relax this in a quantitative model. So here, the model is less transparent because there's lots of kind of behavioral forces that are inside the quantitative model. But it's more realistic in many ways. And so we add different productivity by age as people get older. We also introduced bequest rather than annuities. So now we say, oh, there's a bequest motive for saving. That turns out to be really important to understand why people don't decumulate assets. It's just the bequest motive is critical there. And then we have other types of fiscal rules. So thinking about pension adjustment, thinking about cutting the level of pensions or increasing taxes or pushing out the retirement age. And so as you do that, of course, you're going to get different effects on asset accumulation and interest rates from aging. Right? And so this table just shows you the types of wealthy types of effects that we can get. And so I don't have time to get through the specifics, but the basic result that comes out of this, which kind of came to our surprise actually, is that increasing longevity actually doesn't do that much on its own to the basic results. Right? So it's not the case that the fertility, which is what was driving our baseline model, is kind of a limitation of just focusing on that, because the compositional effect at the end of the day, when you do it according to our formula, the compositional effect is the bigger driver of the total increase in the wealth to GDP ratio at constant interest rates. And these behavioral effects can be there, but they're not as big, except if you think that there's going to be massive fiscal adjustments that are very one-sided for life cycle accumulation, like cutting the pension benefits. So if you cut pension benefits, then you definitely get people to save a lot more. And so that then accelerates the decline in interest rates. So this is at the very bottom when you say only lower benefits. And on the other hand, if you adjust in the other side by just taxing people a lot more and maintaining the pension level, then there'll be a lot less saving, and so a lot less of a decline in the real interest rate. Right? So just to briefly conclude on this demographic reversal idea, so if you think about savings, you can actually get to a situation where at a constant interest rate, demographics pushes down on savings, as in the Goodhart and Pradhan type of scenario. So that isn't wrong, but you have to also think about investment, right? So there's a complementary analysis in the paper, thinking about not asset demand versus supply, but savings versus investment. And demographic change pushes down on desired investment. And actually, that force can be really, really big in neoclassical models. Right? And so what this diagram shows you is, if you put together the decline in savings that might come from demographic together with plausible decline in investment, you actually get to the same point as what we have in our model with a decline in interest rate. And it's just that you can't forget that other force. And so the great demographic reversal just thinks about one versus, but not the other. Okay, so just to conclude, how do demographics affect wealth to output, real interest rates, and capital flows? What we argue is what matters the most here is this compositional effect. And that's something that you can measure in the data. It's large and heterogeneous. And so for the 21st century, our approach refutes this great demographic reversal hypothesis and then suggests the global savings glut has just begun. Thanks.
Thanks a lot, Adrien. And for the sake of our lunch break, I will get through the panel discussion right away in the order that our speakers talk. So I'll start with Oscar. You mentioned various macroeconomic challenges imposed by the aging population and longevity as well. What do you think could be implications for monetary policy, in particular monetary policy framework? Do you think that in any way this would imply targeting a higher inflation rate, or in terms of the use of the instruments, or more broadly for the maybe more complementary role for macroprudential policy and banking supervision for monetary policy?
Thank you, Phyllis. Well, these are very many questions, by the way, and very deep, all of them. So I will try to provide, even if only a partial answer, to the potential implications of aging for monetary policy in the euro area. So to this aim, maybe some of you know that the ECB is working in the update of its monetary policy strategic framework that should probably come in the second half of this year, according to the official announcements. It's good to go back to what we did in 2021, the latest, the most recent update of our monetary policy strategy. At that time, our view was that demographic changes at the moment would probably contribute to the by then dominant context in monetary policy, which, if you remember, was the situation of the low for longer, low interest rates, low inflation, probably for a long period of time. So at that time, we thought that through its negative impact on Arce demographics would essentially represent a disinflationary force in net terms. Now, if I had to update this kind of view, given what we have seen in the last few years, and we have seen a lot during the pandemic and in the aftermath of the pandemic, much of what I said this morning covers this recent period, probably I would have a more balanced view about the connection between aging and inflation, and hence between aging and monetary policy. Why I'm saying this? Well, because we have realized, we have seen in the last few years that demographics may generate some pockets of inflationary pressures, especially, but not only, in the labor market. I mean, we have seen a lot of issues of shortages of skilled workers, and this is very much linked to the ongoing process of aging. I mean, we have, at the Eurosystem level, we have some good evidence. Let me mention here a recent study by my colleagues of the Bundesbank in Germany that offered very good evidence about many German corporates in the industrial sector trying to hoard labor as much as they can because they expect a lot of retirements in the coming years. Retirements of people with long experiences, high levels of skills that are very difficult to replace in the market. So labor hoarding, shortages of labor, and so on, at the end of the day, imply directly or indirectly higher unit labor cost, and this means higher inflation. So my view today on the connection between aging and inflation and monetary policy is probably a little bit more nuanced, a little bit more balanced than the view prevailing just some 5 years ago. We have not mentioned much today issues more related to, let's say, the demand side of the economy. I mean, these days we are seeing a lot of activity and at some point also relatively high and persistent inflation in some parts of the economy. Services are still subject to relatively high level pressures from the demand side relative to the supply. And some people, I don't have hard evidence on this, but let me share these thoughts with you. Some people say that this sometimes has to do with some preferences changes at the aggregate level that essentially represent changes in demographics. The silver economy, in a sense. We are seeing more people, for instance, traveling around, people that are retired with relatively very good health conditions, with relatively high incomes, that are traveling more than similar people in this moment of the life cycle could do just 10 years ago. And this may have consequences on the pattern of aggregate demand and, of course, on prices, inflation, and eventually monetary policy. So let me conclude. I think we have to be a little bit more pragmatic at this stage. I mean, these direct channels through Arce savings and investment and so on are probably first order, but there are some other elements around that should also be taken into account, especially those forces running through the labor market may pose some inflationary threats down the road. And for policymakers, for monetary policymakers, these are uncharted waters. At least we have not seen this situation in the many last decades, and we have to remain very attentive to that as well.
Thank you. Thanks. Very interesting. And for David, David, you mentioned about the change in the way that people will be receiving their pensions and or accumulating from defined benefit systems to defined contribution. And you mentioned that this naturally implies some of more risk-taking than we had before. Of course, this has implications for financial institutions and policymakers alike. What does this imply for macroprudential policy or the supervision of financial institutions?
Thanks. I think the implications of demographic change and some of the things I talked about with pensions for monetary policy are not trivial, but I don't think they're not even close to being amongst the really difficult issues for monetary policy. I mean, difficult issues for monetary policy are when you get like an unexpected sudden shock, the global financial crisis. So interest rates in many countries, we can all remember, were 4 or 5% nominal. They go to zero. In some cases, they go to negative numbers. Or COVID, pretty much the same thing happens. And it's not just in nominal rates. I mean, in real rates as well. I mean, there's a good measure of real rates, which is the return on inflation-proof government bonds. The ones issued by the UK government, one of the biggest issuers of inflation-proof bonds, in the period either side of COVID, changed enormously. So movements in real interest rates of 4 or 5% in just a few years are not uncommon. In contrast, I mean, the very clear and very useful presentations by Andrea and Adrien show that you can get substantial changes in real interest rates that should affect how you set monetary policy just because of demographics. But of course, they're very slow moving. It's maybe 2%, 2, 3%, which is very large if you think of that as a change in a sort of neutral real rate, but over 50 years. So that's much, much easier to handle than the really difficult problems for monetary policy. I mean, I don't want to suggest that there are no interesting monetary policy problems that come from aging. The transmission mechanism of monetary policy, I'm sure, will be different when you have different relative numbers of younger to older people, because younger and older people at different points in the life cycle have different responses to changes in the main policy measure that central banks have, which is interest rates. And central banks will, see an evolution in the transmission mechanism, the sensitivity of the overall economy to changes in interest rates, as the relative numbers of older and younger people, older people, got more assets, younger people perhaps saving very little, high gearing, lots of mortgage debt potentially, and there's going to be fewer of those people and more people who are at a stage in their life where they don't have a mortgage, they don't have much debt, they have rather a large amount of assets. Those people have different responses to unexpected changes in interest rates. So that's a thing. But again, it's kind of relatively slow moving. There's an impact also on macroprudential policies, one of the most important of which is to try to control volatility from the housing market. And with fewer younger people who have just entered the housing market with a very large amount of mortgage debt, then the need to use and the effectiveness of macroprudential policy aimed at the housing market, which is the main one that's used by central banks at the moment, will be somewhat reduced. Just a final thought. I used to think that the monetary policy effects of demographics were much bigger than, and more problematic, perhaps, than I think they are now. That was when I was at the Bank of England. And now I spend more time at the Office of Budget Responsibility in the UK, which is very close to the Finance Ministry, thinking only about fiscal issues. I think the fiscal issues are really difficult, and the monetary policy issues are much less so. But there is a link, just a final thought. The more difficult the fiscal policy position becomes, the more pressure, explicit, less explicit, behind closed doors, in open, the more pressure from the fiscal authorities on the central bank to help out with the fiscal situation. And that is a political problem as much as it's an economic problem. And it may be that that is the most difficult problem for central banks to deal with. And it's not because of relatively slow-moving movements in the neutral real rate of interest driven by changes in the capital or the wealth-to-income ratios of the country, which, as I say, I think are relatively slow. You can sort of respond to them gradually over time. The fiscal pressures, I think, are huge. And if governments don't deal with them very well, they may look for the central bank to help. And that is not what the central bank wants to see happening.
Thank you. Thanks, David. I move to Andrea. So you have seen, you showed us very credibly that the role of demographic trends in the decline of global real interest rates since 1990s. How do you see this trend moving forward? Of course, we know the statistics from the aging side, but this will interact with some other structural forces or geopolitical tensions that we are seeing. I'm asking this question also because you highlighted the role for financial integration in this, and we know that some of these trends may be reversing in the other direction. What are your views on this for the future?
Now it's working. Yeah, I think it's a fascinating question because it's very multidimensional. On the demographic side, we have projections, and so we can say something based on those projections. Those projections themselves, I use them, just the central projection, Adrien shows already some difference depending on which variant you think about. And in addition, we were talking with Oscar before over the coffee break. We know that in the past there's been underestimation of some of these trends. I was once at a conference in Japan where the Bank of Japan showed that it took their statistical agency about a decade to accept the decline in fertility rate. I think that is not uncommon. At the same time, as Oscar again showed us earlier this morning, immigration may have the opposite effect. And so there's clearly, you know, an element of uncertainty around what's going to happen in the future. Not to mention what Andy alluded earlier, which is how the economy will actually react, because typically this analysis is done at given current conditions, but obviously we know that there is an element of endogenous response that may take a little bit of time to happen. On the second part of your question, which is about the interaction, I think, with some of the other factors that have been discussed, you know, in my presentation and other presentations. I mean, on the fiscal side, obviously, David just mentioned that. Again, we often consider them separately. I mean, you know, I showed these results about fiscal policy based on what happened post-pandemic. Larry Summers had a couple of papers saying that basically fiscal policy is what kept interest rates up relative to everything else that was happening with demographics and productivity. One thing that it's important, maybe it's a bit more nerdy, but I think we should keep in mind is that those results depend a lot on the fiscal rule that you assume. And because these are models where Ricardian equivalence doesn't hold, so the stand that you take on fiscal policy matters a lot. And so Adrien had a result where his adjustment was coming from government spending. My adjustment in my model, if it comes from taxes, and already that's going to give you some different results. So I think that this interaction about fiscal decisions on which we don't necessarily know a lot. We don't really have a Taylor rule for fiscal policy that we sort of agree on. It's very important, and I think a similar point applies to pensions. Not to mention that, this point about the demand for safe assets also, evolves as population ages, and so that's, I think, it's really difficult. On the TFP side, I think the work of Williams, Lubbock and Williams has highlighted the forces of how productivity can affect interest rates. Even there may be some endogeneity in terms of how much innovations economies perform, and it goes back to some of the points that Andy was making this morning, right? Are we going to have less entrepreneurs who innovate, or are we going to have people who respond more aggressively? Because there isn't a big need for innovation that is related to health and aging. So I think these are all open questions. On balance, I think that at current conditions, given the projections that we have, I still see the pressure being on interest rate, at least being on the downside. But again, there is a lot of uncertainty, so it's really hard to come up with a straight, definitive answer.
So moving to Adrien, you mentioned the implications for global imbalances, and also you touched upon the role of demographics also on the decline in real interest rates. Do we have a bit more evidence on the risk premium for the markets? On one may think of certain uncertainties introduced by demographic trends, as well as the change in the pension systems, as David mentioned, in a way that encourages more risk-taking for the society as a whole, and as well as the financial institutions. So one may also imagine risk premium increasing going forward. What are your views on this? And also, what would that imply for the demand for safe assets and reserve currencies?
Thanks. Yeah, so this is a new version of the paper that we recently put out that started thinking about these risk premium issues, because it's kind of a natural question to ask when you're thinking about demographics, not just to think about predicting effects on the overall level of interest rates, but also on different rate of return between, say, safe and risky. And so one fact that's really striking, if you look at the aggregate data, looking at portfolio composition by age, is that people just tilt their portfolios towards safer kind of assets as they age. So partly this is automatically done in the US with things like target date funds that rebalance portfolios. And so one implication of that is just that as demographic change unfolds, there's going to be just increasing demand for safety. Right? So to some extent that kind of gets a bit counterbalanced by a fact that, at least in the UK, that David was talking about, where there's also a shift away from defined benefits that invest a lot in safe assets towards defined contribution that have more risky. So we'd have to kind of see how the whole thing kind of together plays out. So if you take as a given that demand for safety increases, that's likely to push down on safe rates relative to risky rates, right? And so then the question is, there's sort of two things. There's overall demand for total assets that's pushing down on the interest rate in a way that I was describing in the paper, or in the presentation. And then in addition to that, there may be a wedge between safe and risky that might start to open up because people just demand more safety as they age. Now, the exact extent of this is governed by like the elasticity of portfolio tilts to changes in the risk premium, and I think we just don't have that much evidence on that. And in fact, when I ask my finance colleagues, what are the trends in the risk premium over time, they can't even tell me what that is, right? And so I think there's kind of agreement that risk-free rates are falling. There's much less agreement as to what the risk premium is doing, and so then, given this, it's actually hard to put in hard evidence that disciplines a model that requires this key elasticity. And so, you could speculate, and so in the paper we kind of look at a range of potential elasticities, but we don't have really hard evidence because unfortunately the expected returns are really hard to calculate. So.
Thank you, thanks a lot. So now we open the floor for questions. Yes, Alvaro.
Well, I have a couple questions and comments. First of all, regarding the savings issue and the difference between countries, and we talk about India and China, but those guys don't have proper social security systems. And so one of the things that we've been seeing, and part of the reasons why you have global imbalances between China and the United States, that we know that because there's not a good social security system, people save a lot more now, so that at old age they're able to subsist, basically. And so we've been arguing for a long time that providing good social security systems might also help China decrease the imbalance that we have in terms of trade. So we're interested to know about that. Second, most of you don't mention or don't take into account technical change, right? So labor-saving innovations. We have papers from Acemoglu, Restrepo, and others, but a lot of evidence that shows that labor-saving innovations likely will go up with aging. Basically, think about Japan. One of the countries that has more industrial robots. Singapore, Germany. Aging is accelerating. It seems this type of innovation. So it'll be interesting to know whether you have something regarding technical change in our analysis. And finally, regarding savings, who is saving basically? Because we just came out with a paper on investment. And we argue that basically since the global financial crisis and then our COVID, there was a huge decrease in investment, especially business investment. And the question is why? One of the reasons that we talked about is the difference between intangibles and tangibles. So what we've been seeing is that many firms in the past 15, 20 years have started saving more than they usually do. And we think, again, we need to do more evidence and more research on this, but we think it's partly because right now intangible investment became a lot more important, and they don't get the lending from banks, or the traditional sources of lending is not there. So intangibles depreciate very fast, about 25% depreciation rate. And if I want to invest in software, if I want to invest in R&D and organizational capital, I cannot go to a bank to lend me money. So what I do, I save more. So I was wondering whether Adrien and Andrea and Oscar have looked into this, the type of saver, who is saving, and whether this is related to potentially the decline of the interest rates. Thank you.
Yeah, please come in as you wish.
Also, a couple of comments on a bunch of questions, but on social security. So I think, so yes, of course, putting in place social security systems will dampen kind of the demand for private saving, and also has maybe some redistributive benefits that we might like. On the other hand, this is very present in France right now in the public debate. If you entirely rely on kind of social security for pension provision, then you have an effective rate of return, which is the growth rate of your economy, and that might be much less than the rate of return that you might achieve in financial markets. So, if there's this difference between R and G, you might want to start thinking about ways that you can give people the types of market returns that are available out there. Right, and so there I thought David had some interesting thoughts on, could we maybe have something that combines some of the benefits of social security system with the rates of return that we might think are higher in places like China. And so that's kind of one thing to think about, just how do you design your social security system in the face of especially demographic, very fast demographic change. On innovation, I think there's kind of, we don't really, the evidence isn't really there, but I think you could do an analysis that's similar to what I did, taking behavior as fixed at the different ages, and then actually it looks like the innovators tend to be kind of middle age, right? So there's more innovators that are middle aged than there are young or older innovators, and so so that might suggest, if you just said, well, holding behavior constant as demographic change unfolds, what will the innovation rate do? And you might think that there's a little bit of a headwind and then kind of a tailwind after that. And so I don't know how much people have looked at that, but I thought it'd be an interesting thing to do.
Thanks, Oscar.
Yeah, if I may say something in connection with the last question by Alvaro, who is saving? You were asking. Well, I can refer only to the euro area. So first of all, the savings rate in the euro area is pretty high right now. It went up during the pandemic, then a little bit down. But now it's quite high. It's significantly higher than in the US. It's around 15% of disposable income. So this is a way order of magnitude above that in the US. No? We have run some exercises in trying to understand why people are saving that much in the euro area. There are a number of factors. Some are probably cyclical, temporary. I mean, people were saving more because interest rates have been relatively high until very recently. Uncertainty was high. They were trying to rebuild the real value of their nominally depleted assets after the high inflation period. But one interesting element that probably we should investigate a little bit more is that we cannot reject the hypothesis that there are some kind of Ricardian elements in the savings function that we tend to associate precisely with a desire by European households to save, not that much to pay for future taxes, this is probably too sophisticated reasoning, but to save on account of public pension systems that are expected probably to provide a declining level of welfare, as I think David was highlighting this morning. So people are saving a lot. Probably they are saving in part to cover for this later stage of the life cycle. Who is saving? In the euro area is mostly the top quintile of the distribution of income. The rest of the people save very, very little. Something that we have not discussed today very much here is about distributional issues across ages. In the income distribution, you can see some interesting things, probably in connection with the protection of rights of current pensioners. We know that politically they are a very important demographic group. But for those of you who have the talent to do serious things with figures, I would invite you to look at the distribution of the stock of wealth in the last very few years, maybe 20 years, with a special focus on the housing stock. I mean, I know some countries in Europe in which there has been just a huge redistribution of the housing stock from the young cohorts before the global financial crisis, that in many cases came also as a housing crisis, to the most recent period. So in some cases, these figures are quite striking. I mean, we have seen a huge reallocation from younger households to more senior households, with implications probably in many orders of our economic life that are going to be probably persistent and that are going also to bring some questions on distribution of resources across the economy. I don't have an answer for this, but let me put my 5 cents in terms of questions.
Thank you. Andrea, do you want to come in?
Very briefly, because I think Oscar and Adrien already touched upon the key point. I think the way I read the debate on technical change and technology in general is that there are optimists and pessimists a little bit about the demographic shifts have been characterized earlier by Andy. And you really need to think about how the technical change is going to happen and who is going to affect. So I think that's crucial. So I haven't worked on that, so I don't really have an answer, but that's my reading of the literature. The other point on whose savings, I mean, I think from what I've seen, I agree with what's been said, that, you know, it's people at the top end of distribution. These are not really super young people, typically, which, you know, goes a little bit in contrast to some of our models where, you know, if you foresee living longer, you would tend to save when you're pretty young. So, you know, there is an element of discrepancy there. I thought Adrien may have something to say about that, because you have heterogeneity also within cohort, and it's not something that I think you emphasize very much, but his models has something to say about that. And finally, quickly on China, I mean, it's true, China doesn't have a social security system. I mean, in some sense, also in the US, there's a lot of private saving for pension. And, you know, I think recommendation of Social Security are great, but then the fiscal side, how do you fund them? Like lots of countries that do have Social Security system are getting in trouble, are trying to find ways to move away from that model. So I think there's the other side of the question, which is, you know, the fiscal side.
Thank you. I promised before Panos to Sakvoğlu a question, so Panos, would you like to ask your question? No, okay. Yes, please.
It's more of a clarification than a question. The demographic reversal has a very clear, intuitive explanation. Okay, it's grounded in the life cycle model. And both speakers seem to reject that expectation. And I'm just wondering what their intuition is, or in simple terms. Why should the life cycle hypothesis be amended, rejected? Incidentally, Keynes was expecting exactly the opposite from the life cycle hypothesis, I mean, on behavioral grounds. He was expecting a savings glut as the population grew.
So in the simple Modigliani model, it's a simple life cycle model, you have income during your working age and then little income later, and so you save for retirement, and then at the end of life, you've totally depleted your assets, right? And so the implication of that model for life cycle savings are kind of contradicted by the data, because we don't actually see this decumulation phase, almost at all. We see it a little bit, but not that much. And so there's a whole literature that thinks about why is it that people continue to save in old age. And some of this might be, might have to do with bequest motives. Some of this might have to do with desire to, make sure that you have enough money in case you become very ill. And so you have like old age kind of health expenses, and so on and so forth. So there's a debate out there in the literature. And so what that means is that the savings rates actually for the elderly, they're a little bit negative, but just not that much, right? And so that's part one, which is what's wrong with the life cycle hypothesis? Well, I mean, we don't know exactly, but for sure, the implication of it for the age profile of asset accumulation is not borne out by the data, right? So that's part one. And then on the demographic reversal, there's kind of two components to it. So one says, in the life cycle hypothesis, you see a lot of dissaving, you see just a little bit of dissaving. Now, it's true that that little bit of dissaving can induce a small decline in the savings rate as people age for given interest rate. But then when you think about what determines interest rates, it's the balance between savings and investment. So even if savings falls a little bit, at given interest rates, the amount of capital that firms want to accumulate as demographics unfolds, there's decline in the population growth rate. And so that's a huge effect on investment. So there's just much less demand for investment from firms in a world where the growth rate of the labor force has slowed down. And so basically, it's, the life cycle hypothesis just thinks huge decline in savings, not in investment. In practice, there's small decline in savings and a much bigger decline in investment. And so that's what explains those results. I mean, we've seen a lot of papers that show the same thing, but going forward, we're projecting declines in interest rates, so no great demographic reversal.
Yeah, in our model, it's sort of similar. I mean, if anything, I guess it's even starker because we don't have bequests. And so in our model, it's all coming from the fact that people expect to live longer. So even once you're retired, this fact that you expect to live longer implies that you're still kind of saving. You can interpret that savings for health because you're worried about deterioration of health, or purely the fact that you're living longer. So it goes back to the answer that I gave to Andy before, that if you change retirement age, you can affect that behavior quite significantly. But right now, you will need to change retirement age massively in a way that you're going to have people in the streets, I think. If you'd done it 20 years ago, 30 years ago, it would have been a totally different game.
Thank you. We can get one more question.
A question for David. Some of the discussion you had about the collective DC kind of agreements, you sort of take as given that the government needs to step back from providing both the intergenerational transfers and the risk-taking. Could you speak to what should the role of government be in providing both kind of absorbing the risk, regardless of financial institutions versus households, and also the intergenerational transfers?
Already on. Oh, they go. What should the role of government be? Well, it may be that government can, and maybe they're the only institution that can, do intergenerational risk sharing. But you have to be sure, for the government to do that successfully, they have to be able to work out whether there's a shock that is a temporary shock that's very bad for a current group of people of a certain age who are here now, and the chances are things will be a lot better in the future, so you borrow a lot of money, and you use that, and you pay it all out, and then you get the tax back later. But then later you have to do your side of the bargain. So when later things are better, or at least normal, you need to pay off the debt. So a government that successfully does that is doing something extremely useful. It's, it's what you would want governments to do. And sometimes they do exactly that. I mean, you see it in wars, that countries run up huge amounts of debt during a war. They have no choice in a way. They're not going to tax the current generation who are fighting the war and increase tax rates enormously to run balanced budgets in wartime. And then after the war, you hope that things will be better and you will gradually pay it off. And some countries very successfully done that many times. I'm familiar with UK's history better than most other countries. There are 3 times when the UK has done that really well: the Napoleonic Wars, the First World War, and the Second World War. The problem now is that the kind of things that we're talking about with aging, it's not obvious that this is like a temporary thing and you could run big deficits now and see the stock go up and then get the money back later. And so I'm kind of skeptical about that intergenerational risk sharing being something that you would expect governments to be using right now, and certainly as any kind of justification for the sorts of deficits that lots of countries are running. You see it in the US, you certainly see it in the UK, in a world in which the stock of debt has just gone up a lot. The scope to do intergenerational risk sharing then is much diminished, and that's why I think the fiscal situation is just phenomenally difficult at the moment. And just as a final thought, I'm actually quite surprised that bond markets are, as in some sense, as sanguine as they look in still being willing to lend to most governments in real terms at very low real interest rates. And maybe that'll last and maybe it won't. I don't know.
Thank you so much. So we are finishing a few minutes late, but given our excellent speakers. I think this is justified. Thanks a lot for all the great presentations, questions and answers, and our discussion. And our conference will resume at 2 p.m. after lunch. Thank you.